Mr. Rana Ashutosh Kumar Singh, Managing Director of State Bank of India, joins us. Now, Mr. Singh, good morning. Thank you for joining us. The economy seems to be slowing down, and it is evident in the way how Reserve Bank of India has reduced their GDP estimates. Are you also feeling the heat? And if GDP is down, could that be a precursor of credit growth going down for SBI?
Good morning. Thank you, Nikunji, for having me here. If you see the MPC statement by the Honorable Governor, so Q2 was kind of an aberration, and the expectation is that Q3 onwards, the growth will be good. So I don't see that there will be maybe dip in the credit demand. Retail credit also with Q3 because of the festive season and all, we expect that the Q3 will be a better number. Corporate credit growth, we don't see any dip in the demand. So no, answer is no.
The fact that CRR has been cut, it means more liquidity comes in the system. If more liquidity comes in the system, can we expect that at least if not SBI, other banks and NBFCs, they will start lending again, and that will kickstart the entire credit cycle?
So I don't think from the bank side, SBI and the banks also, there was a decline in credit because of the liquidity. Liquidity was maybe to an extent some issue with some of the institutions, but not the system as a whole. Definitely this CRR cut liquidity will be better, and some may be uptick for the banks in terms of the NII, little bit improvement in the NII.
So if CRR is down, that will have impact on bond yields. If bond yields are down, that means credit offtake, the treasury portfolio for the entire banking sector will move higher. And since SBI has the largest book in the bond market in India, do you think the impact in the near term could be a meaningful one for SBI?
Not kind of very significant, I would say. Little bit, yes, maybe, but not very significant.
You mentioned that retail credit could be better in Q3. What is the basis of this assumption? Because one side government is saying, or one side RBI is saying that go easy on unsecured loans. And if unsecured loans as a category they fall, directly, indirectly, they will have impact on retail care credit.
So I'm talking about less on the unsecured credit, more on the, so Q3 is essentially festive seasons, and always this is traditionally we see that there is uptick in demand for home loans, there is uptick in demand for auto loans. The secured portfolio I'm talking about. Unsecured for us, you know this mostly is unsecured we call our express credit, but that is essentially given to the service class, the customers we have. So kind of secured, but the demand growth on retail side also mostly will happen in the home loans and auto loans, which are secured portfolios. And that is traditionally, this is how it happens every year.
Government spending also has taken a hit, and that has also impacted the growth. And State Bank of India is going to be, is involved in a lot of government projects, both directly and indirectly. What is your understanding of the government spending and how this could impact SBI and the banking sector per se? Do you expect government spending to pick up? If it does, where do you think it will pick up the most?
I expect government spending particularly a lot of pickup for the simple reason that general election was there in the first half of the first quarter of the financial year. And then major states, they went for elections. So now elections are over in Maharashtra and a couple of other states, Haryana and Jharkhand. So model code of conduct, always we know that there are some spending will be a little less. So going forward, we see a lot of uptick in the government spending as well. And that will help essentially on the liquidity side also. The liquidity is coming into the market, that will support the banks also.
To understand your outlook on the overall landscape as well, on growth of deposits and the narrowing gap that we're seeing between credit and deposit growth. Is that something that you've noticed?
That is almost the, if you see the growth pattern in the deposit, the numbers we are seeing is, and you have noticed the RBI latest data also. So it's kind of converging now again. It happens in the every 3-4 years, there will be a cycle where the graph will, the divergence will happen. But now we see the convergence has started happening. And in absolute numbers, the credit and deposit growth numbers are same. In terms of percentage also, the deposit rate has gone up to roughly 10% of the kind of YOY basis, and the credit growth also has come down a little bit. So its convergence has started happening now.
We are going through a interesting phase in the banking sector. One side, big banks are getting a huge advantage because of the strong liability franchise. Small banks are suffering because credit is strong and liability is not going them, and NBFCs have to slow down because of the high growth they've maintained, and government in a sense is worried about the kind of growth they they are maintaining. If the sector has to reboot itself, where NBFCs slow down, small tier banks, they suffer because of liability issues. Do you think big banks like SBI will be the biggest beneficiary? And do you think that in a sense could help SBI even to regain more market share?
If we say see on the liability side, in fact, our saving bank growth is it's not as per the traditionally what it used to be, but that is maybe the industry itself. But in terms of market share, we have gained market share already in Q2, and I won't say that whether SBI will be a gainer or not. Overall, we believe that if industry, the economy has to grow, the country has to grow, the industry overall has to be in a healthy condition. And of course, there were some anomalies, and we have seen some actions coming from RBI also. So some maybe I would say corrections has happened in the ecosystem, overall ecosystem. And in SBI, our focus definitely is on the both side, liability side also, asset side also. Traditionally, we had focused more on the liability was kind of franchise we have. It was kind of taken for granted. Granted means that it was flowing to the bank. Service was always a focus, but now we have little more focus on the liability portfolio also. We have teams relationship. We are expanding the relationship team. We are expanding the network, the franchise. So yeah, this is a focus area. And I still believe that the industry overall should be in healthy condition to support the growth the economy needs.
For SBI, where does the number stand, Mr. Singh, in terms of the credit growth versus liability? How big is the mismatch? Do you see it narrowing down?
Yeah, almost I would say that it is converged. It has converged. Almost.
When I spoke to Mr. Shetty last time, he in a sense delighted everybody when he said that SBI is aiming to cross a PPOP number of 1 lakh crore, something which no Indian bank has ever dreamt of, and SBI is on course to deliver it. Looking at the smile on your face, looks like SBI will deliver it this year itself.
Let's hope so.
But for SBI to do, sir, that kind of growth, how long this growth can continue without raising capital? Because you've not raised any tier 1 capital after COVID.
As of now, we have sufficient capital to support the growth we are projecting. But going forward, the kind of profit plowback we have done in last 3-4 years, you know the numbers. It is in excess of 1 trillion rupees. So that has kind of supported our growth so far. And we hope that the kind of profitability we will have, that will keep supporting us. If needed going forward, we'll see in the course of time, depending upon any further need for raising capital. But recently we raised some 81 also, you are aware of that.
You know, for the longest time, we've discussed with banks about NPAs which are coming from the corporate sector, which are coming from the SME sector. We've never asked banks about what is happening to the retail delinquencies, what is happening to the retail credit. But now cracks are there, Mr. Singh. Credit card defaults, unsecured loans at NBFCs, car loans, home loans, cracks have started coming up. So do you think next 2 or 3 years for any bank, whether it is SBI or a small bank, private bank, or a small bank, there could be a bit of a challenge in terms of how the retail credit book would move?
I can comment on SBI book. That is what I should do. So SBI side, we don't see any big issue coming in our retail portfolio. Home loan is strong. Auto loans is strong. We have not seen much delinquency there. Unsecured credit, again, we always say that our book is gold standard. This is mostly to service the salaried class we have. So I don't see personally something kind of significant happening on the delinquency side in our retail portfolio. Overall industry, we are seeing some correction happening, and maybe that was the need of the hour also. That was the RBI concern as well, and industry is responding.
That same point again, Mr. Singh, I don't want to get this one wrong. Very, very crucial for us to get this number right. India's GDP has been revised by about 100 bips by Reserve Bank of India. Credit function or credit growth is a function of GDP plus nominal GDP. So if credit growth is a function of nominal GDP and GDP, you at SBI or SBI still feels that the credit growth which they had guided for at the beginning of the year, despite the downward revision by RBI, you don't see that coming down.
I don't see that coming now because the corporate loan book, the pipeline we have, that is significant, and we are not seeing any kind of decline in that. Retail side, Q3 numbers will be better than Q2 numbers definitely because of the reasons we discussed just now. So going forward, I don't see any dip in our credit portfolio. So the guidance is 14%, 15%. That is the growth we expect to see, and we don't see any challenge there. And again, if economy has to grow, the GDP growth number has to come back, which was there earlier. Credit support has to happen, credit growth demand has to happen, and we are seeing that demand from the economy.
And from the corporate sector, is this coming for working capital or is this coming for term loan? Because while both are classified as corporate, they both are different functions.
It's both. So new proposals, we are seeing capex proposals, and working capital utilization is going up. So both sides, I would say.
I can say that for SBI, all is well. I mean, we should not look at what is happening to the economy. We should not look at what is happening to the credit, overall aggregate growth. All is well at SBI, both in terms of growth, NPAs, liability franchise, and delinquencies.
We are extremely optimistic about the growth of our economy, and we are extremely optimistic and confident for the growth of SBI and our profitability. So you mentioned about our chairman saying about 1 trillion PPOP number. We are also another aspiration we have is to be the first Indian company to cross 1 trillion of net profit in a couple of years' time. A $10 billion profit.
Appreciate your time. Thank you so much for joining in and sharing with us those growth metrics and what the overall linkage is to the kind of macroeconomic setup that we have. Good speaking with you. If
you like this video, then like, share and subscribe to ET Now.